Okay, this is Professor Hazara for the second of the four videos on the basics of revenue recognition. In this video, we have two objectives. First one is to go over a performance obligation. What does that mean in the context of contracts and revenue recognition? And the other sort of objective here is I'm going to go through the 5 steps using performance obligations concept. I'm going to go through 5 steps, which are outlined by the FASB when you're accounting for revenue, especially when you're accounting for revenue in complex contracts. And the steps are basically common sense, but it's a good review to go through an example with all 5 steps. Okay, so let's start with the first objective here. Performance obligation in a contract is exactly what the term implies, an obligation to perform a service or deliver a good under the terms of a contract. Okay, really, most contracts have a single performance obligation, such as you buy a pair of sunglasses from Amazon, you buy anything from Amazon, their performance obligation is to deliver you the glasses, and you've got to pay for them, but probably you've already paid for them in advance with Amazon, so that would be a simple contract with one performance obligation. Some contracts, and this is increasingly true, some contracts have more than one performance obligation. The most common example that I can come up with is an iPhone. If you buy an iPhone, I guess, I don't have an iPhone, but if you buy an iPhone and you buy some of the services that come along with it, I assume that you can buy an iPhone and package some subscription, like a music subscription or some gaming subscription along with it, then you might get a package deal with it. In that case, Apple would have two obligations, performance obligations. One would be to deliver the iPhone, and the revenue on that obviously would be recognized immediately upon delivery. But the other one might be to deliver you a 1 or 2 year subscription for music or whatever, and that revenue would be recognized over the period in which that service is provided, 1 or 2 years. And that's why it's important to identify performance obligations in the contract, because each one may have a different point of time or period of time delivery. So you've got to say, here's what we're going to do. You've got to do performance obligation 1, performance obligation 2, and the timing of the revenue may be very, very different. That's why this is important. Okay, and then each obligation must be valued. And here's another problem: is that sometimes things are sold in a package deal. So if things are sold, two performance obligations, let's say an iPhone and a subscription, are sold for one price, how much of that revenue do you assign to the iPhone, and how much of that revenue do you assign to the subscription you got? So that's another issue. I'm going to cover the most basic situation when you have sort of package deals in this video, and then the book covers other ones, but I'm going to cover the most basic one. Okay, so this is an example. The example I'm going to go through is it's the example that's in the book, and it's not a bad example, and I liked it. I had a couple of questions about it, but I liked it because it's a very basic example, and it has a couple of performance obligations of the type I just talked about for Apple, and it kind of shows you how to allocate the revenue. It's a good one too for going through the 5 steps. Okay, so it is from the book. I want to make sure everybody recognizes that. Okay, so we have a manufacturer of some sort of hardware called TrueBox. Okay, it's a game playing system, I guess, and it allows people to play games and compete over the internet, playing sports games, whatever. But so you have two possible performance obligations here. One is you have the delivery of TrueBox, which is a piece of hardware which allows you to access sporting games and competitions on the internet. And the other one is maybe a subscription to some game system itself. Okay, so this is where we're going with this. Okay, here's the facts. The TrueBox system, this is the hardware, includes the physical TrueBox as well as a 1 year subscription to the TrueNet multi-year system platform of internet games and other applications. So you have two possible performance obligations here. They're appearing. One is you have a TrueBox, which is the hardware, and the other one is the ability to play games, or they have a system called TrueNet, which you can subscribe to, and I guess you can play games, you compete with other people on the internet based on this platform. Now, I think there's next two pieces of information are very, very important. True Tech is the name of the company, and True Tech sells 1 year subscriptions to its TrueNet network of games. Now, a 1 year subscription is worth. Now, this is very important. If you were to buy a 1 year subscription separately from the TrueBox system, box, hardware, whatever, you would pay $60. That's going to be very important. The separate fair market values of each of the performance obligations is going to be very important. Customers can access the TriNet uh, system of games using the TrueBox as well as other gaming platforms. That's a very important piece of information too. So there's two pieces of information that says subscription to this network of games costs $60, but can access you can access this system of games that True Tech, the company, sells using either the company's own TrueBox hardware or other gaming platforms. So there's probably other pieces of hardware made by other companies that you can use. Next one's also very important. The box itself, if you were to buy a True Box itself, which is a piece of hardware to access the games, it has a standalone price of $240. Okay, and here's another important piece of information. It's kind of repeated from the last one. Customers can use the TrueBox to access the TrueNet, which is the gaming system sponsored by the company that we're looking at, True Tech. So you can use their own box to access TriNet, but you can also access other gaming platforms with it. So both the system itself and the box itself are very, very flexible. The system, what I mean by system, is the network of games. You can access, if you subscribe to subscription for TrueNet, you can access TrueNet using the boxing system as well as other gaming platforms. So the system can be accessed using the hardware manufactured by this True Tech company, or it can also be accessed with other hardware from other companies, and that's going to be very important. And then you can use and it's sort of repetitive, but customers can use TrueBox system to access TrueNet as well as other gaming systems. So basically, the box can be used to access many different gaming platforms. Okay, as a package deal, True Tech is offering with the subscription, if you buy both at once, both a TrueBox and a gaming subscription, that you pay $250 for it. So you got to, if you bought them separately, you pay 60 plus 240, that's $300. But if you buy them as a package deal, you pay $250. So the question is going to be, if you buy them as a package deal, how much that $250 is assigned to the TrueBox hardware, how much is assigned to the TrueNet gaming system. And the relevant question is going to be, that's very important, because the relevant question is going to be, when do you recognize revenue? Well, for the box is when you sell it. For the system, it's going to be the 1 year the 1 year period over which people have that subscription for. Okay, so let's go through. We're about to go through the 5 steps here, but let's set it up a little bit here. Okay, so on January 1, 2027, True Tech delivers 1,000 TriBox systems to, I'm going to put here, that's a store right there, to com stores. I'm going to put 2 there, 2 com stores. Do this because I want to make sure you understand this is a separate store. So True Tech delivers 1,000 TriBox systems to com stores for $250 per system. They also are delivering with each one of these a subscription to the TriNet gaming system. So they're basically delivering 1,000 package deals to com stores, in which each package deal costs $250. you get the customer will get one of the modules, one of the toolbox hardware which is worth $240 separately, and a subscription for $60, which is worth $60 separately. They've got this package deal, but there's nothing in the contract that says that CompuStores has to sell those together. They can actually split them up probably, and that's going to be important here. Okay, now there's 5 steps for recognizing revenue under this system. And these are formal steps the FASB has promulgated. So I'm going to go through each one. Most of them are common sense. This situation is very simple, but it's nice to know the steps because you may be asked about on the CPA exam. Okay, the first one is identify the contract. Well, the example assumes that Crew Tech already has written deals with CompuStores, so the contract is already set, which says that they'll buy a system for $250, but they can split the box. They can sell the box separately or the gaming network separately. Okay, so that's the contract. We noticed. Okay, identify the performance obligations, not obligations. Identify the performance obligations. Very important here. And there's 2, and it's basic common sense. Okay, but here are the two formal criteria that are used to identify performance obligations. Now, I do question something that the book says here, but I'm going to make an assumption that there are 2 performance obligations. Each one is separate, the box from the system itself, but the 2 formal criteria for assessing whether something is a performance obligation or not is that, first of all, the activity, like the gaming system or the item that you're selling, has to be capable of being distinct, which basically says you must be able to identify it, basically. Okay, and this is the case for for both the True Box and the subscriptions. Basically, they're separate things. There's 2 separate things which can be sold in the market. You can sell the hardware in the market, or you can sell the subscriptions in the market. The hardware for $240, the subscriptions for $40 each. And you can use, and it's might be important and you can use the True Box to play games on other gaming systems that are not manufactured by this company. So you can definitely identify each one. Okay, now this is the one where I'm a little bit iffy on the example, but I'm just going to go with it. Okay, in addition to that, within the context of the contract, each one of the services must be sort of separately identifiable from other goods and services in the contract, which means that in the contract, each good must be separate. You're selling something. You're not selling like a bunch of paint and hardware and wood to build a shed, let's say, because you'd put those together and build a shed. And so you can't really, those would be pieces of one big product. But in this case, you have 2 separate products. One is the True Box, which can be used by itself with the system sold by TrueNet or the other gaming systems. And all you have the subscription. So they are 2 separate products, even within this contract. And I'm kind of making the assumption that ComStore didn't say this, but I'm kind of making the assumption that they may be buying these from TrueTech as a separate deal, but that CompuStores does not have to sell them. They can sell them separate, which is possible. Okay, so I'm going to make that assumption so that they are separately within the contract. Nothing in the contract says you're buying them as a package and to sell them as a package. I'm thinking to myself, you can sell them separately, so they're definitely within the contract, separate items. Okay. So that's step number 1. Okay, and so given these things, thus the contract has 2 performance obligations: the delivery of 1,000 True Boxes, Tri Boxes, whatever they're called, and 1,000 subscriptions gaming systems. So there are 2 performance obligations, and I'm going to sort of speak ahead here. But the important part of this is one obligation are the True Boxes, and those will be the revenue of those will be recognized when they're delivered. Whereas that for the subscriptions, the revenue for those is going to be spread out over. They're the 1-year subscriptions, so it's going to be spread out over 12 months. Okay, that's step number 2 is identifying the performance obligations. We have 2. One is delivery of 1,000 True Boxes. The other one is delivery of 1,000 subscriptions. Okay, the next one is determine the value price of the contract. Well, that's very easy of the total contract. The total contract here is they're selling 1,000 items packaged for $250. So the price of the contract is $250,000. For $250, by paying $250, CompU stores will get one true box and one subscription that they can sell to their customers, either together or separately. That's up to them. Okay, the next one is probably a very important one. This is allocate the transaction price, which is $250, to each of the performance obligations. And following most accounting principles, this is an old accounting standard, but there's a lot of things that you buy as package deals. When you buy a piece of real estate, land and a building, you pay one price for both the land and a building. You don't pay separate prices for the land and building. And then you've got to find a way to, put a certain part of the price on the building, a certain part of the price on the land. And you usually do this using the fair market value of each. What would the land sell if it were a separate fair market value item? And what would the building sell for if it were a separate fair market value item? That's kind of how it's done typically. And that's how I'm going to do this here. And that's how the book does it, at least initially. Okay, so what we're going to do is the allocation, we're going to take the 250 and allocate it based on the standalone prices, which are the fair market values of the individual performance obligations. Okay, as noted above, a standalone True Box is $240, while a separate TrueNet subscription is $60. So we're gonna assign the 250. It's just going to be assigned, as we call it, based on the relative fair market values of the two performance obligations here. Okay, so you've got True Box, okay, and you've got the subscription, and the price for both, for the package deal is $250. The question is, of that $250, how much do we assign to the boxes and how much do we assign to the subscriptions? Well, we're going to assign 80% of the $250 to the boxes. And here's the calculation. It's pretty easy. It's the boxes separately sell for $240. That's on top. On the bottom, you've got the combined fair market values of the two, which is $240 for the boxes, plus $60 for the subscriptions. So $240 over $300 gives you 80%. So this number here, 200, is we're just going to take 250, and since the True Box on a relative fair market value basis is 80% of the value of both items combined, then we're going to assign 80% of 250 to the True Boxes. And then subscriptions, as it's common sense that if you have two items and one has been assigned 80% of the value, the other one has to come out to 20% of the value, because they've got to add to 100%. And that's just $60 over the combined fair market values of 240 and 60 for the plus 260 for the box and the subscription. So of the 250, 20% or $50 is going to be assigned to the subscriptions. And once again, what's the importance of this? It's because any amount, the revenue that's assigned to the True Box is going to be recognized when those 1,000 True Boxes are delivered, and then the revenue for the TriNet subscriptions is going to have to be apportioned or spread out over the 12-month subscriptions dates for that. Okay, so here's what we're going to have to be. Okay, so here's what we're going to have. The final thing is you allocate the revenue point in time or period of time. I should put point in time or period of time when the good service is delivered. Okay, and the problem itself says, if you go way back up here, it says that I believe on January 1st, 2027, TrueBox actually delivered the 1,000 TriBox systems. And so you can recognize revenue for those at the point of delivery. So on January 1, 2027, you're going to have an entry to credit accounts receivable. Okay, we're assuming it's on credit. It doesn't matter if you debit cash. It wouldn't matter. Okay, so we're going to debit accounts receivable, and we're going to credit revenue for 250, which is 1,000 times the 250, because once they deliver the box, probably means that the subscription goes along with it because they're paying 250. So the total amount they're owed is 250. Now, the sales revenue that they're going to recognize is 200,000, which is 1,000 boxes times this $200 right here. 1,000 boxes times that $200 there that were of the 250 was a portion to the boxes. So of the 250, 200 per box, or 1,000 times 200, 200,000, is going to be recognized immediately because the boxes were delivered on January 1st. The rest of it, or $50 per subscription, $50,000 for each of the $1,000 subscriptions, it's going to go into unearned revenue, unearned deferred revenue, call it what you want, because you're going to owe this service for the next 12 months. In a sense, they have paid you in advance, or you have a receivable that they'll probably pay off very quickly. Your receivable, and they'll pay you, and then you owe over the next 12 months, assuming you sell them quickly, which I assume it's part of the problem, is that you're going to owe somebody a subscription for 12 months. Okay, so to recognize that, you first put that into the liability. You can recognize 200,000 because the box has been delivered. This 50,000 has got to be spread out over the next 12 months, assuming people buy these things quickly, and then they take delivery. They play over the next 12 months very quickly. Okay, this entry immediately recognizes the $200,000 delivery for the boxes. However, the $50,000 subscriptions will be recognized over the next 12 months. Thus, you have to make a monthly adjusting entry, like most companies do actually have closure books on a monthly basis. But what you're going to do is every month you're going to credit the deferred revenue account and write down that 50,000, and every month you're going to credit subscriptions revenue because you will have delivered 1/12 of that $50,000 in revenue that you're owed for the value of the subscriptions at 4167. And keep in mind that this entry that this is a monthly entry made in 2027 for the next 12 months. So this is an entry you're going to repeat for 12 months until you recognize 4167 times 12, or $50,000 in revenue. And when you will have written off, when you make this debit right there 12 times, you will have written off this deferred, the unearned revenue account. Okay, so there are 5 steps, and they're very important. And this is a typical example of performance obligation, is you got to identify them, and you separate the revenue based on their relative fair market values, usually, but it's not always possible. Okay, but first, identify the contract. Identify the performance obligation is very important because it's going to affect your timing of revenue recognition. Determine the value of the price of the contract, which in this case is very simple. You're selling 1,000 things packaged, and each one you're selling for $250. But the question comes up: how do you split the $250? Well, I split it 80-20% based on the relative fair market values, and then the final part is you have to recognize the revenue over the time or point in time when the service has been delivered or good has been delivered. All the boxes, 1,000 boxes were delivered. We've said they're worth 200 apiece. They're all delivered on January 1st, so you recognize all that revenue. That this remaining 50,000 subscription, which is recognized over 12 months. So you've got to recognize 1/12 of that revenue, which you owed each month. So that is the amount right there, 4167. And I'm making the assumption that you could make the assumption that they receive cash to it, but or they're going to receive cash very quickly, one or the other. Okay, but this is a good example, I think, of both the system, 5-step system that the FASB uses to recognize revenue, and it's basically a common sense system, and it's also a nice example of multiple performance obligations. We'll give you a problem on this, and it really is the essence of revenue recognition. Is you have a contract, either you have one thing you've got to do, a performance obligation, or you've got maybe 2, 3, 4, 5 things you got to do. In that case, you'd have to identify each one, then come up with value for each one, and then recognize the revenue when it's earned. Okay, so I'll post this video, and we'll go on to the next one. We'll consider variable consideration next.